In the quiet hours of December 26, 2025, a single report from the Silver Institute crossed the wires, noting that global mined silver production had plateaued at 813 million ounces for the year. This figure, unremarkable at first glance, marked the beginning of what would unfold into a complete supply exhaustion by 2027. The markets barely stirred that day, with futures contracts ticking along as if nothing had shifted beneath the surface. Yet this stasis concealed a deeper fracture, one that had been building through 8 consecutive years of deficits, each one eroding the foundations of availability. The official story, as presented by financial networks and government briefings, maintains that silver remains abundant, with recycling and stockpiles sufficient to bridge any temporary gaps. They point to stable prices hovering around $53 per ounce in late 2025, suggesting that industrial users face no immediate disruptions, and that investors should view the metal as a steady hedge rather than a crisis signal. This narrative emphasizes controlled supply chains, where Mexican and Russian mines offset declines elsewhere, keeping the global flow intact. It reassures that demand, projected to dip slightly to 1.12 billion ounces this year, aligns with available resources through efficient allocation. But this version omits the critical undercurrents, the ones that insiders have tracked for months. The suppressed detail emerges from the data itself. By 2030, supply is forecasted to meet only 62 to 70% of demand, which could reach 48,000 to 54,000 tons annually, driven relentlessly by the solar industry's expansion. On November 13, 2025, the Silver Institute quietly acknowledged a structural market deficit for the 5th year running, with a projected shortfall of 117 million ounces in 2025 alone. This isn't a forecast. It's a confirmation of trends already in motion, where corporate actors like solar panel manufacturers have begun securing forward contracts at premiums unseen in decades. State entities, particularly in China and India, have accelerated their acquisitions, hoarding reserves that vanish from public inventories without fanfare. These moves aren't speculative. They reflect a calculated response to the erosion of mine output, where higher production in select regions masks the broader stagnation. The crack widens here in the numbers that official channels downplay. A 206 million ounce deficit anticipated for 2025, the 8th in succession, signaling that the buffer zones are depleting faster than acknowledged. This detail, buried in specialized reports, reveals how the system's assurances rest on outdated assumptions, ignoring the accelerating drain from emerging technologies. As these facts surface, the contrast sharpens between the polished surface and the underlying strain. The public is told to trust the equilibrium, but the data whispers of an imbalance that has already tipped. By early 2026, whispers from the trading floors began to harden into documented moves. On February 18, 2026, a major industrial buyer, identified in industry circles as a leading solar panel manufacturer based in Southeast Asia, quietly exercised options to take physical delivery of 1,200 metric tons of silver from COMEX vaults in New York. The consequence was immediate and visible only to those watching the delivery reports. Registered inventories dropped by 18% within a single month, the steepest monthly decline recorded since the 1980s Hunt Brothers episode. This was not a paper transaction settled in cash. The metal was withdrawn and shipped to fabrication facilities, never to re-enter exchange warehouses. The action carried no public announcement, no press release, just the cold mechanics of standing for delivery on contracts that had previously rolled over for years. That single withdrawal removed roughly 38.6 million ounces from the system, equivalent to nearly 5% of annual global mine production. The market failure became unmistakable in the spring of 2026. COMEX reported delivery delays stretching from days to weeks as refiners struggled to source bars meeting exact specifications. Spot prices on the exchange hovered around $58 per ounce. Yet physical dealers in London, Zurich, and Singapore quoted premiums of 12 to 18% above the futures price for immediate allocation. Bars that once sat on shelves for months now moved within hours, and many smaller wholesalers simply stopped offering 1-ounce rounds, citing no available supply at any price. The LBMA's daily silver fix, long considered the global benchmark, began showing unusual volatility in the bid-ask spread, with gaps widening to levels last seen during the 2020 pandemic scramble. Inventory data, once updated weekly, started arriving with increasing delays. By June 2026, the CME Group quietly removed the registered versus eligible distinction from public reports, replacing it with a single aggregated figure that offered less transparency. This opacity was not accidental. It coincided with the first reported instances of force majeure clauses being invoked by refiners in Peru and Mexico, citing equipment failures and labor disputes that conveniently aligned with depleted ore grades. The system was no longer functioning as advertised. Paper contracts promised delivery that physical metal could not honor. Traders who had relied on the convergence of futures and spot prices found the basis blowing out to historic levels, with physical metal commanding a persistent and growing premium. The disconnect was no longer a glitch. It had become the new normal. The demand collision arrived not as a single event, but as a convergence of irreversible commitments. By mid-2026, global photovoltaic installations had already exceeded 450 gigawatts for the year, each panel requiring an average of 15 to 20 grams of silver in conductive paste that cannot be meaningfully substituted without sacrificing efficiency. Electric vehicle production, led by manufacturers in China and Europe, surpassed 18 million units annually, with battery electric models consuming 25 to 50 grams per vehicle in wiring, sensors, and power electronics. Military procurement added its own layer. Advanced guidance systems, radar arrays, and satellite communications drew steadily from refined stockpiles, quantities that governments do not disclose, but which appear in aggregate refinery throughput data. Grid modernization programs, particularly in North America and Asia, incorporated silver in high-voltage switches and transformers to handle renewable intermittency and rising loads from data centers. AI infrastructure compounded the pressure, as server farms expanded power capacity by more than 50% year over year, each facility relying on silver-plated contacts and connectors for reliable, high current performance. These systems don't wait for price discovery. Contracts were signed years in advance, production lines calibrated to exact specifications, and supply chains locked into long-term offtake agreements that now required fulfillment regardless of spot pricing. The result was a fixed, non-negotiable draw on physical metal that accelerated throughout 2026 and into 2027. Central banks and large commercial institutions had historically intervened during precious metals rallies, either through overt leasing programs or by signaling restraint to commercial shorts. In previous cycles, elevated prices triggered visible position adjustments, increased COMEX open interest on the short side, coordinated releases from government stockpiles, or public statements emphasizing ample, above-ground reserves. This time, they didn't. JP Morgan, long the dominant player in silver derivatives, reduced its net short exposure by more than 40% between January's and September 2026, according to CFTC disclosures, without replacing it through new positions. The U.S. Treasury remained silent on its deep storage holdings, neither confirming nor denying availability for lease. European central banks, traditionally active lenders, reported zero new silver lending activity in their quarterly updates. China, already the largest state accumulator, continued quiet purchases through state refiners, adding an estimated 60 tons in the first half of 2027 alone. Even the Bank for International Settlements noted in its annual report that silver leasing rates had turned negative for extended tenors, meaning borrowers were effectively paying to hold metal rather than lend it out. This absence of counterpressure marked a regime change. The institutions that once stabilized the market at key thresholds now stood aside, either unable or unwilling to replenish the physical flow. The consequence became clear in delivery statistics. By early 2027, COMEX registered stocks had fallen below 100 million ounces for the first time in decades, while physical premiums in major hubs reached sustained levels of 25 to 35% over the quoted futures price. The point of no return materialized in the third quarter of 2027. On August 14, 2027, the COMEX declared delivery failure on 4,800 contracts representing 24 million ounces, the first outright default in the exchange's modern history. The metal simply did not exist in registered vaults to satisfy notices tendered by long position holders who had paid full margin and demanded physical bars. Settlement was forced in cash at the prevailing futures price of $112 per ounce, while off-exchange dealers quoted immediate delivery 100-ounce bars at $168, an effective 50% premium that exposed the complete decoupling of the paper market from reality. Refiners in Switzerland and India issued public notices suspending new orders for kilobar fabrication, citing zero available feedstock from mining concentrates. Peru's largest silver producer invoked force majeure indefinitely after ore grades fell below economic thresholds. Mexico, responsible for roughly 23% of global supply, imposed informal export restrictions as state authorities redirected output to domestic industrial users. These events were not coordinated announcements. They emerged independently across continents, yet they converged on the same outcome: physical supply exhaustion. Above-ground stocks that had buffered deficits for decades were gone. The system had crossed into territory where additional price could no longer elicit additional ounces. This moment echoed a precedent that few discussed openly. In August 1971, the United States closed the gold window, suspending convertibility of dollars into gold for foreign central banks after years of steady drain on Fort Knox reserves. The official narrative at the time emphasized temporary measures and ample liquidity. Yet the closure marked the end of the Bretton Woods fixed exchange regime and the beginning of pure fiat currency expansion. Similarly, in September 2008, The repo market froze when Lehman Brothers collapsed, revealing that trillions in paper claims rested on a narrow base of acceptable collateral that suddenly vanished. Counterparties refused to lend against even high-grade assets, forcing emergency central bank interventions that redefined monetary boundaries. The 2020 repo panics followed the same pattern. Overnight funding markets seized despite abundant reserves on paper, requiring the Federal Reserve to inject hundreds of billions to restore flow. Each episode shared a common structure: persistent deficits masked by financial engineering, followed by a quiet depletion of the underlying asset, culminating in a visible break when delivery could no longer be met. The 2027 silver default fits this sequence precisely. The difference lies in the asset itself. Unlike dollars or treasury securities, silver cannot be created through balance sheet expansion. Once the physical buffer disappeared, no authority could reopen a window or print a substitute. The parallel is not speculative, it is structural. History has already demonstrated what follows when a critical monetary or industrial commodity reaches absolute scarcity within a leveraged pricing system. The real question is no longer whether the silver market will rebalance through modest adjustments in price or production. It is whether the global economy can continue expanding its commitments to electrification, renewable generation, and digital infrastructure without access to the physical metal those systems require. The precedents of 1971, 2-8, and 2020 each involved assets that authorities could expand or substitute through policy. Dollars, collateral, liquidity. Silver offers no such option. Mine output remains constrained by geology and byproduct economics, with primary silver mines contributing less than 30% of annual supply, and their remainder tied to lead, zinc, and copper projects that respond slowly, if at all, to silver prices. Recycling rates, while helpful, have plateaued near 20% of total supply, and cannot scale rapidly enough to offset structural deficits. The cumulative draw on above-ground stock since 2021 now exceeds 800 million ounces, according to aggregated Silver Institute estimates, leaving progressively thinner buffers. As inventories approach operational minimums in refineries, vaults, and industrial pipelines, the margin for error disappears. Price becomes the only rationing mechanism left, yet even elevated levels, reaching sustained highs above 70 per ounce in late 2025, have failed to elicit meaningful new supply while demand compounds. This is the quiet warning embedded in the data. The shift is already underway, visible in the widening premiums for physical delivery, the unprecedented withdrawal rates from COMEX vaults in December 2025, and the absence of traditional suppression when prices tested new thresholds. Systems built on assumptions of infinite substitutability and seamless allocation are encountering absolute limits. Those who recognize the pattern early, securing allocation before the visible breaks, have positioned themselves outside the constriction. If you're watching this unfold now, with inventories depleted and commitments locked in, you're early. The adjustment ahead will not be gradual.